Well, stocks gained ground last week with the S&P 500 notching its best weekly gain since May as the dollar rolled over just a little bit and gold started to shine once more, while markets here in the UK digested a budget that really doesn't please anyone. The week ahead sees us start finally down the home stretch of 2025 with 3 proper trading weeks of the year left to go, although we do have a lightish data docket this week given the delays to the November US labour market report, and with focus already starting to turn towards this month's busy calendar of central bank meetings, including the FOMC next Wednesday. In any case, plenty for us to discuss on the trade-off this week. So without further ado, let's crack on with the show. So 3 weeks left to run in 2025. Here we are at long last. Joining me to make sense, as always, of everything that's going on is my good friend, Ryan Littlestone from Forex Live and Forex Analytics. And Ryan, it must be said that last week, I would argue, was probably one of the strangest that I've had in terms of doing this job, certainly given all of the trading outages that we had from the CME on Friday. It was a very anticlimactic and frankly peculiar end to the week, I think.
Yeah, I'm glad I was off Friday in the end, given the mess you were left with. But I've got to say, have you lost a page on your calendar? I thought there was 4 weeks in December, and considering it's the 1st and it ends on the 31st, we know what's happening. You've only got 3 weeks because of your lunches. So yeah, let's apologise to our viewers for the fact that we're not going to have any shows after this in December, because obviously Mike's lunch schedule is far more important than bringing you up-to-date analysis and trade ideas.
Well, you are correct. My lunch schedule is far more important than that. And I wish that was the reason we were away. But it's actually because our producer has recently welcomed a new arrival and he would rather look after the new child than look after us 2 children, which, is probably fair enough on his part, I would say. Anyway, speaking of children, we've got plenty to discuss. And we're going to start with politics and the UK budget.
Actually, that favourite subject.
Sorry?
Our favourite subject.
Well, yeah, exactly. I mean, we just can't escape it at the moment. And I was just thinking it might be a bit harsh on children because I think they're probably more economically literate than the policies that were produced last week. But there we go. Of course, we did get the budget last Wednesday. And after countless trial balloons and leaks and rumours and an emergency press conference from the Chancellor, I think it was just the cherry on top of the cake that the entire thing actually leaked an hour early because the OBR made a complete pig's ear of releasing their economic and financial outlook, which, just sums up the farcical nature of the last 3 months of UK fiscal policy. The actual measures within that budget were pretty much as we expected. We all know that the Chancellor does not like to surprise, does not like to pull rabbits out of the hat, and she certainly didn't this time around, delivering a £26 billion worth of tax increases, with the majority of that revenue to be raised from a 3-year extension to the freeze on income tax thresholds. And that will fund in excess of £10 billion worth of additional government spending, including the welfare U-turn from the summer and the scrapping of the 2-child benefit cap that the Chancellor announced in the budget last week. When you throw those 2 things together and you add in the OBR's latest forecasts, they now project fiscal headroom of £22 billion, which is more than double the 9.9 billion that Rachel Reeves left herself in the spring. Although it must be said that the OBR did also downgrade their trend productivity growth forecast as expected, and also now pencil in slower GDP growth in every single year of the Parliament compared to where they were back in the spring. And actually, the OBR said in their forecast document that there are a grand total of 0 measures in that budget to boost economic growth, which for a government that claims growth is its number 1 mission, the actions don't particularly reflect the words at this point. For financial markets, though, I think it was very much a case of, it could have been worse, because we saw gilts rally fairly significantly in the aftermath of the budget, albeit helped at the long end by the Debt Management Office scrapping some longer end auctions. But we'd also saw gains in the pound as well, with cable reclaiming the 132 figure and actually notching its best weekly gain since August. However, while the near-term event risk of the budget has been navigated, I think there are a few political factors that are likely to continue exerting some pressure. The first is obviously, as I said, growth likely to remain very, very anemic indeed as a result of there being no policies to improve it in that budget document. The second is that the spending hikes the government are delivering are front-loaded, i.e. they come now. The tax hikes are backloaded. They don't come for 3 or 4 years. And at the moment, the majority of them are penciled in for 2029, which is the same year as the next election here in the UK, which is simply not credible. And the third is that there are now increasing question marks over what Rachel Reeves knew and when, and more importantly, perhaps whether she misled the public and financial markets over the true state of the public finances. So I think the Chancellor and the PM have probably given themselves enough room and bought themselves enough support with the Parliamentary Labour Party to muddle through until May. But realistically, in my mind, and please do convince me if I'm wrong, the budget doesn't change much in terms of the UK economic outlook, which remains pretty gloomy in my view.
Yeah, it does. I mean, what a shower this budget was. That leak before fat finger, whatever you want to call it. There's still an investigation going on about that. It was a shambles. But that's par for the course at the moment for us in the UK. We can't even get data out properly, and now we've got the OBR can't even forecast when they're going to release their own budget numbers. So that's the state of things at the moment. Politically, because I'm going to talk about the pound and the moves in a moment. Politically, we've come out of the budget into this. All knives are out for Reeves at the moment over what she knew, what she didn't know leading up to the budget. She had that emergency press conference because everything was going to be so bad, and now things aren't as bad as it seems. And apparently, according to those OBR numbers, they weren't as bad when she gave that press conference either. So Starmer was out earlier today trying to smooth the waters, saying, oh, no, she didn't mislead anybody. Well, the numbers and facts speak for themselves, however he spun it. So we're going to be seeing a bit of a political shift, I think, over the next few days, which could impact the pound, impact bonds as well, and the market, just generally thinking that these lot don't know what they're doing. So there is a small risk that perhaps this grows into something and maybe it forces Reeves out. Starmer's not going to be forced out at all, but Reeves has been on a hot tin roof, shall we say, for a while, and this won't be making her case for staying in the job any better as it goes along. So, yeah, just watch the next couple of days, I think, just to see if something does happen, and then that's going to upset markets because we'll be wondering who's going to come in and will they be worse.
Well, exactly.
And a stretch to find anyone worse than her, but trust me, we can do it.
Well, I think you're absolutely right, and that's where you've got to remember that for markets, I think the case and actually the reaction we saw last week reflects this. Reeves is still, and Starmer, the sort of least bad option among the likely contenders within the Labour Party to do those two jobs, and I think that's why you would see a significantly adverse reaction if there were mounting risks of either of those leaving their post, as we saw in the summer when Reeves was in tears in the Commons, and then, well, the gilt market ended up in tears pretty quickly after that. That's very much a reflection that those two are much more likely to display some degree of fiscal discipline, not a huge degree of fiscal discipline, but some, and certainly more than their peers on the left of the Labour Party would likely do so. But let's move on to the pound, because, as I said, best week since August for the quid last week. But I would question how durable those gains are personally.
Yeah, they're already been wiped out at the moment. So really, we need to look at what happens next. And given the US holiday, the market took a little bit of a break too, and perhaps what we see this week is
someone turned the market off.
No, exactly. But we obviously going to see trading. We have seen trading picking up as we're recording this. So that means the reality of the budget and the data that follows is going to be the driver of the pound moving forward. Now, the price action over the budget pretty much went exactly as we explained and expected last week. The market liked the fiscal restraint, the numbers, gilt yields dropped, pound went up, 30-year gilts didn't quite get back to that 5.12% level I was looking for, but euro sterling did drop back as well. But this morning they have bounced back again. This is that political mess I've just been speaking about. Euro sterling, that managed to get down and stall around the 87.40 50s, which I highlighted last week. And we've seen a bounce today, as I say, as we record this, back up close to 88. Although some of that was a bit more euro led than pound led this morning. Now, as we discussed just now, there was nothing stimulatory in that budget, so that's not good. And I think moving forward, that's going to be pretty negative for the pound. And just because a lot of those tax hikes are not to come in for a while, that doesn't make it positive for the pound either. It just keeps this cloud hanging over the economy that firms and households will probably react to now rather than whatever happens in 3 years' time. Now, that may mean we get a short burst of boost of activity in this month as maybe consumers think, sod it, let's go and have a blowout before we start getting clobbered with all these taxes, which will bring, a short bit of a jump in activity. But businesses might be thinking otherwise. They'll be thinking a bit more long term, and they'll be more forward looking and thinking about those costs, which could hit hiring in the interim. So overall, I'm happy to stay short the pound via long euro sterling. The fact that the economy is weaker at the moment, now we're over the budget hump, the Bank of England comes to the fore as well, and they might indicate they're ready to hike at a slightly faster clip now, but I don't think that's going to happen until maybe the new year, because we have got that December meeting, which I think will be a bit of a can kick. However, given the carry costs in euro sterling, I may close this position up towards the latter part of December when markets are going into holiday mode, and put it back on in the new year, just so I'm not paying those costs for 2 weeks while it does nothing. But for next year, I'll be looking for a move in this pair up towards a 90 level at the very least.
Yeah, I think that's really how we need to look at the budget. We obviously know roughly what the economic outlook looked like pre-budget. How has that changed post-budget? And you alluded to BOE. Are they still on track to cut at the December meeting? I think almost certainly that there was some degree of inflationary element to that budget from the national living wage hike, but that's probably offset by things like the freeze to rail fares, money off energy bills, et cetera, et cetera. Do risks to growth remain tilted to the downside? Well, yes, absolutely, because there was nothing in the budget to tilt them the other way. If anything, we've now got political uncertainty as opposed to fiscal uncertainty, which might actually be worse in terms of businesses dealing with it. And there was that report out from the IOD earlier on, which had, I think, net approval for businesses at a record low, although I may be slightly wide of the mark on that one, certainly lower than it was after the Truss Kwarteng budget. And then you actually go, well, does this materially reduce the risk that Reeves is, I say Reeves, a Chancellor, because I don't think she's going to be in the job next autumn, but does this materially reduce the risk that the Chancellor at the time is going to have to come back for the third year in a row and deliver significant tax hikes, and the doom loop continues for a fourth year? Well, I would argue the risks of that are still very, very high indeed, given that although, yes, the headroom has been boosted to 22 billion, there's a number of assumptions in there, these backloaded tax hikes, faster wage growth, et cetera, et cetera. It's not going to take a lot for when the OBR release their forecasts in the spring, that headroom to have started to evaporate again.
Yeah, exactly. And, I know you've mentioned these minimum wage hikes as well. Hefty, what was it, 4.1% or something?
Yeah, that's about 9% for the youngsters, I think.
Yeah, but that's all well and good if firms are going to pass that on or not go, well, that's too much for us, we're going to cut workers instead. And then, okay, you might get a bit of inflation, but you're going to see a higher unemployment rate alongside it, and it's going to potentially stymie further hiring. So you're going to have a weak jobs market, and then that's something that's going to bring disinflationary pressure after you've had that 1 month jump in the wage numbers. So it's a bit of a mess. And I've been saying it since July, really. I've never been this bearish on the UK. I've always been a glass half full kind of guy. We've always managed to, that bulldog spirit, and when everyone says we're disappearing into a fiery abyss, we pull it out. But I just don't see it, and I'm very fearful for the new year.
Yeah, and I would be with you on that one. I am, as most people would know, not usually a glass half full person. But even for me, I think the biggest worry is that, not only are we pessimistic now, but there's sort of no obvious get out of jail free card on the horizon that digs us out of the rather big hole that we're in. Last point on the UK, and I know we had this conversation in your chat room earlier, but we may as well have it on camera as well. You mentioned unemployment and how that's rising. I mean, we're already at 5% in terms of 3 months to September. The BOE expect unemployment to peak at 5.1%, which feels a bit ambitious, if I'm being honest. Why, when unemployment has gone from 4 to 5% in less than a year, the economy has shed jobs in 11 of the last 12 months, why is no one mentioning the R word, the recession
That is a bit strange, which shows you, but what has the economy been doing? We're not like coming off 2, 3, 4% economy and hurrying lower. We've been flatlining for the best part of 2 years. So yes, we could hit recession, but it's not as if it's coming off big levels. So I think we're just going to see this sideways action hovering around the 0% mark, because there's not really much more to look. There is, but in respect, there's not that much more to lose. There's not that much more to gain. I mean, it could happen early part of next year. It could happen, particularly that spring announcement from the OBR, their updated forecast. If productivity was getting downgraded for this budget for the end of this year, and then productivity isn't going to improve going forward if we're going to see a weak jobs market. So, those forecasts are going to be in the mud again. But yeah, you're right. And I think we will start seeing those recession calls and potentially some recessionary type data coming in next year.
Yeah, I mean, it's just an interesting one. I mean, in a manner of speaking, it doesn't matter, which sounds silly, I know. But, when, as you alluded to, growth has been, I think, less than 0.3% in 4 of the last 5 quarters here in the UK. If you suddenly get a couple of quarters where we contract by 1/10 or 2/10, it's a technical recession on paper, but you're probably not really going to feel that because growth has been so anemic anyway. But there we go. Maybe one that we're going to look at in 2026. Go on.
Yeah, just to finally put the nail in this coffin, I think it goes back to what you said last week about taking money off the productive and give it to the non-productive. The non-productive are still going to be spending that money, and that conversely might keep the economy afloat.
Yeah, well, you and I just keep hammering away, keep paying our income tax. If I'm gonna get a picture of Rachel Reeves on my desk just to remind me who I'm working for every day. When I feel a little bit down and glum on a dark, cold morning, I can just look at dear old Rach there, and I'll be back firing on all cylinders again.
I'm going to change my backdrop next year. I'm going to have Rachel Reeves as my backdrop, and then you can see her all the time then.
Oh, please don't. God help us. Anyway, let's move on before we get ourselves in trouble on that front well, actually, I think we're both going to start looking ahead to 2026 a little bit, because as Ryan said, it is our last show of the year today. I want to have a look at the monetary policy outlook, not only in terms of this month, but also in terms of into next year as well. We'll do a bit of a sort of whistle-stop tour around G10 very quickly. The FOMC, of course, meet next week on the 10th. The market pricing about a 9 in 10 chance that they deliver a 25 basis point cut. And I think I would argue at this point that that's actually the best evidence that it's going to happen, because we did not see any real pushback on that market pricing before the blackout period came into effect on Friday. And we know that the committee really don't like to surprise compared to market expectations. However, it's not only going to be a divided FOMC with dissents likely on both sides in terms of keeping rates unchanged, and also probably Governor Myron voting for a 50 basis point cut, but probably a hawkish cut in terms of the guidance as well. I think it's difficult to imagine the Fed explicitly guiding that they will continue to cut at every meeting in the early part of 2026. So certainly one to watch there. Here in Europe, the Bank of England, obviously we've alluded to earlier on, a December rate cut is pretty much nailed on. CPI.
What do you mean here in Europe? We're out of Europe.
Oh, well,
come on.
Don't go all Reform UK on me, mate. Come on.
I'm just pointing out facts, mate. Sorry.
We are in Europe. We are not in the EU. Let's clarify that one. But on this side of the Atlantic, if that pleases the pedants among our viewers and our co-hosts, a December rate cut is pretty much nailed on. The CPI does look to have peaked. The budget was not hugely inflationary in nature, and obviously the labour market weakening at a rapid pace, as we've already discussed. The big question is whether the MPC now look to speed up the pace of easing and start moving at consecutive meetings as opposed to this quarterly pace that they've been moving at up to now. Across the channel in Europe, actually in Europe this time, the ECB, they seem to be done and dusted for the time being. There were some sources pieces out the other week and minutes from the October meeting saying that basically the 2028 projections don't carry much weight and we should be looking much more at what inflation is doing in the here and now. It does look like the Doves have potentially missed their chance for further easing there, which probably means the deposit rate is on hold throughout next year, and I will be getting a lunch at some point, fingers crossed. In contrast to that, over in Japan, the Bank of Japan, it looks like the stars are aligning for a December rate hike from the BOJ, not only in terms of some of the sources stories that we've had to those ends, but also we had Governor Ueda speaking to start this week, saying that they'll be weighing the pros and the cons of a hike at the December meeting. You don't really say that unless you're actively considering pulling the trigger, and money markets now discount about an 80% chance that they will indeed raise rates to round out the year. And then it's a case of the best of the rest. The RBA and the RBNZ, they are both pretty much done and dusted. The RBNZ having delivered a hawkish rate cut last week. The BOC and the Riksbank are probably on the sidelines as well. Plus the SNB, they're on those sidelines too, unless they decide to return to negative interest rates in 2026, although that seems unlikely for the time being. But the Norges Bank, they will probably deliver another cut, although their pace of easing is almost as slow as the BOJ's pace of tightening, with the middle of next year probably the next time we see action from the folk in Norway. Among all of that, there is quite a lot of divergence. As you see, the Fed potentially making a hawkish pivot, the BOE making a dovish one, the BOJ continuing to tighten, and the best of the rest sat on the sidelines. Guess the question is all that going to be enough to inspire FX volatility? Given the year we've had this year, I won't be holding my breath.
No. And that's something I fear for next year as well, because, yeah, we've still got some policy divergence, but we're talking small levels, the Fed going down to maybe 3.5, 3.25, the Bank of England the same. The RBA would still be a bit of an outlier out there if they don't get to cutting again. But, we're only talking, as I say, 50, 75 pips between all these banks, the higher ones and the ones who are sitting on their hands at the moment. So, yeah, I think we'll see those gaps closing up at some point, and then I fear for volatility moving forward. We're already seeing euro dollar volatility. The 1 month at the money's down around that low 5% mark. If we're getting under 5%, then we're looking at 20 pip ranges a day, and that's not good. But let's not be too despondent. We've got next year that'll be off with a start, and we've got the end of this year to go as well. We've got obviously all these central banks coming in. Then we've got all that data after the Fed, which will be very, very important, because whatever they've delivered at that Fed meeting next week, that data could flip it around 180 if it's bad or worse or whatever it comes in versus that Fed message. So, yeah, a lot to play for the rest of the year, and we'll worry about next year when we get there.
Well, you're going to worry about next year right now, according to what's on my screen. So, you better eat your words a little bit on that
one. Yeah, better, because I'm not making up another topic off the hoof. So, I'm looking at what we're likely to be trading in 2026. I'm calling it the year of mediocrity, because I don't see any.
Well, there we go, ladies and gents. Time to get excited about that one. Here we go.
Well, there's always a trade, even in that, if you know the conditions that you're going to be expecting. So, yeah, as this is the last trade-off of the year because of Michael's lunch roster, I'm going to try and make this topic a bit of an evergreen one that you can look back on, and you can skip through all Michael's stuff and just jump to this point.
Watch this back in November 2026 and laugh at how wrong he's been.
Well, I'm going to bookmark this now. Yeah, I'm going to look at various economies and how I see them performing next year. Starting in the US, that's probably the toughest to read at the moment. It has been for quite some months. There's plenty of reasons why the economy might soften, but there's just as many reasons why it might not. Or if it does, it probably just be some mild softening. We've already seen that. Now, you can never ignore the sort of never say die attitude of the US, and that's why I think we may see some softness, but we can probably ignore all the doom and gloomers that will no doubt start predicting deep recessions and the like. So the trade will be, for me, the Fed getting rates down to their neutral level, wherever that is, but probably no further, and fade all the doomsayers is my top tip for that one. Moving over to Europe, I think economies over there going to remain in what I call meh territory. They're not going to do anything. We may get an early uptick in the new year driven by all this defence spending and hopefully an end to the Ukraine conflict, but I don't think that's going to last long, and we'll be back to seeing, growth rates at 0. boring percent GDP, going on as we have been for the last 2 years. I do see the scope for more ECB cuts, because if we're getting into to end of Q1 into Q2 and this growth is still remaining anemic, the ECB will just be forced to act. They'll be forced to act to try and stimulate the economy a bit more. That's irrespective of what inflation's doing, which, again, in a low growth environment, we should start seeing inflation coming down again. But for trading, as I just mentioned, I expect volatility to remain low, meaning big price move influence will likely come from whatever opposing currency there is versus the euro, dollar, yen, pound, wherever, at least until the ECB indicate those cuts are coming. Moving over to Japan, I think this is my outlier for among the majors and perhaps the country that may see a decent jump in growth, because for all her fiscal dovishness, Takaichi grabbing the ball by the horns and seemingly doing it responsibly, and unlike the UK, is actually targeting growth with her fiscal measures. It's taken a very long time to fundamentally turn this ship around, but turning it is, and Japan could be up there as one of the best performers next year. So, as Michael said, if all the stars align for the PM, the trade for the yen is that we might see longer bouts of yen strength than yen weakness, much like we've seen in the latter part of this year. Next year, I think a lot of the crosses are going to be important too, in that favour. But for dollar yen, the risk remain from sort of wandering pillar to post versus whatever's happening in the US. So it's not going to be as much a straightforward yen trade next year versus the dollar. So overall, I think aside from the odd exception, I see major economies stumbling along next year, which, while that might be good for volatility, it will be good for range trading. So just be prepared to adjust to whatever trading conditions we get given, and that's how you're going to have to trade it moving forward.
Yeah, indeed. As always, being agile and nimble is absolutely key. I think I agree with the bulk of what you just said. We'll leave the matter of ECB rate cuts or not to one side for the time being, given our bet on that front. I do think we are going to get a lot of doom and gloom about the US economy next year. But fundamentally, you've got a Fed that's going back to neutral and has got a lot of ammunition to deploy in terms of further easing if they see a need for it, if things really do start to head south. You've also got an administration in the White House that's got a real incentive to keep things propped up, because of course next year brings midterm elections in the United States, and Trump and the Republicans are certainly not going to want to go into those midterms trying to stand for re-election on the back of a softening economy. They will want one that is going absolutely gangbusters. So you've got a Trump put along with a Fed put, which should keep the doomsayers to one side for the time being. In terms of Europe, I don't think the ECB are going to go again, but we can leave that there for the time being. And yeah, it will be interesting to see what happens in Japan. Obviously, they are really going for growth in terms of this fiscal stimulus package. And if that does indeed start to pay dividends, you would expect the BOJ for feeling a little bit more emboldened to raise rates further. You'd expect demand for the yen, etc., which is almost the polar opposite of the economic outlook here in the UK. But we won't depress ourselves with that glass half empty nonsense again.
No, let's move on from that very, very quickly. I actually left off the UK because I thought we were going to be talking about it much, so no more need be said.
Well, in that case, we'll do our plays of the day. Right, so as most people will know, I've been bullish equity for the majority of the year, certainly at least since May, and I don't really see any reason to be changing that view as year end approaches, and hopefully a chart will magically appear in a moment to show you why I am still bullish in terms of the equity space. There we go, at long last. As for the narrative behind that move, it's really exactly the same as it has been for quite some time. Those AI jitters appear to have been put to bed it for the time being, with the market refocusing back on a solid fundamental backdrop of resilient earnings growth, a robust underlying economy, helped along by a by a calmer tone on trade, and a looser monetary backdrop. We're now back north of the 50-day moving average as well, which gives the bulls back control of the narrative in the short term. We have positive seasonality into December. Is it too early for me to call a Santa rally? Possibly, but I'm going to do it anyway. But I think all in all, the mix remains a powerful one for stronger gains. I would still be looking to ride the path of least resistance higher, using dips as buying opportunities. The contract high is at 69.50 are the obvious next upside target. And then I guess we get ready for 7,000 before the year is out.
Oh, is that your call, was it? Way back when? 7,000?
Indeed.
Is that another lunch you got riding?
Actually, I don't have a lunch riding on that one, sadly.
Well, I'm not going to take
my waistline will thank me for that, I would imagine.
Yeah, I'm not going to take the other side of that this close to the holidays anyway. So, yeah, you're free with that one.
Yeah, the risk reward really doesn't tilt in your favour there. Anyway, no. Dollar Mex, let's taco about that.
God, let's do it out. Last red card of the year. There we go. We're finishing with a red.
Classic.
Taco about that. Oh, my God. Don't know why I put up with it sometimes, really don't. But yeah, Dollar Mex is
put up with it.
It's true. Well, not enough. Dollar Mex is my top
now, isn't it?
Throw me off. It's been unable to meaningfully get above this 1850 resistance level. Now it's done that for longer than it was support earlier this year. So it shows how absolutely massive this level is, hence why we spent nearly 5 months glued to it. We have tested the 61.8 fib of the April 2024 rally, and that marked the bottom in the move back in September down at 1819. I think it's worthy of me trying a long down there as well, because I don't see any reason why this pair is going to, move right out of this range that we've been in, particularly with the USMCA coming up as well. So unless we get some real continuation of this dollar weakness, I can see this range holding. So I'm going to try a bit of a long scaling down from about 1825 down to 1850, 1900. With a stop below that 18 figure. Now, normally I would look for a break and maybe flip the trade to a short, but I think that any break may see a quick flush lower before bouncing back into the range, much like we've seen on the top side in that 1850 level. So, looking at the bottom of the range for a bit of a long, and we'll see what happens.
Good stuff. Well, that does indeed bring us to the end of another show. It also brings us to the end of another year here on The Trade-Off. Thank you very much, as always, to Ryan Littlestone for joining me and putting up with God only knows how many puns throughout the last 12 months. Thank you.
If I may, I would like, just on behalf of myself, to thank all our viewers who have followed us over this last year. We'll obviously be back in January, but I hope you have a happy holidays, happy Christmas, happy New Year. And thank you for watching.
Yes, indeed. Absolutely. Thank you as well to our producer, Kyriakos. None of this would happen without him, to be honest with you. We have the easy job. He has to make us look pretty and make it look like we know what we're doing in the post-production. So thank you very much, as always, Kyriakos. And as Ryan said, thank you very much indeed for watching. Hopefully you have a brilliant December, a happy Christmas, and happy New Year as well, of course. And we will be back in January to do it all over again in 2026, whatever that year may hold. In the meantime, thank you very much, as always, for watching, and goodbye for now.